Hey guys, today let's talk about the RRSP, what it is, how it works, and most importantly, how it can help you save and invest more money on your financial journey. Super important as we're approaching the RRSP deadline on March 3rd this year, and you want to make sure that you make the most of your RRSP. The RRSP, or Registered Retirement Savings Plan, is one of the many savings plans that is registered with the CRA, which is the Canada Revenue Agency or the tax agency in Canada. The other plans are the TFSA, FHSA, RESP, and RDSP. The RRSP was set up to encourage Canadians to save up for retirement for the long term so that when you stop working someday, you'll have something to live off of apart from the CPP or Canada Pension Plan, which at an average monthly payout of $800 or so will not be enough. But saving for retirement is not the main benefit of the RRSP. You can save for retirement outside of an RRSP. So why invest in an RRSP? By putting money into an RRSP, or what is called contributing, you can save taxes. Not just a few dollars, but thousands of dollars in many cases. And this can happen in two ways. First, by sheltering your capital gains. After contributing money to your RRSP, you need to invest it so that it can grow. And you'll likely earn some income from your investments in the form of interest payments, dividends, or capital gains. This is, for example, when you buy a stock, then sell it at a profit. Outside of a registered account, this capital gain would be subject to taxes, but within an RRSP, you don't pay any taxes on your investment income. That way, your investments can grow faster. It's sort of like a greenhouse where your money is temporarily protected from animals that want to eat it. But this is a feature that not just the RRSP has, but also the TFSA. So what makes the RRSP truly unique is the next thing, which is deferring taxes. The money you contribute to your RRSP reduces your taxable income. Instead of paying taxes on your full income of $60,000, for example, when you contribute $5,000 to your RRSP, your taxable income can be deducted. In other words, reduced by $5,000, so you'll only get taxed on the remaining $55,000. And we'll go through a number example later. Now, can anyone open an RRSP? Do you have to have Canadian citizenship or PR? The answer is no. The only requirements are these. You have to be a Canadian resident for tax purposes. If you're not sure about your resident status, you can go to canada.ca and enter resident status in the search box. It will lead you through a questionnaire to find out your status. To open an RRSP, you also have to be 71 years or younger, so there's no minimum age, and you need to have earned income and file taxes. Next, you might be wondering how complicated it is to open an RRSP. Good news is that it is very simple. You can open an RRSP with almost any bank or financial institution in Canada. If you go to your bank app on your phone right now, you'll likely find an option to open an RRSP under products or investments. Although remember, the RRSP itself is not a product or investment, but more like a container that shields your investments from taxes. When I opened my first RRSP, I had no clue, so I opened one with one of the 5 big banks and found that the process takes a bit longer and is not as flexible. So I opened another RRSP. And in case you're wondering if you can open more than one RRSP, the answer is yes, you can open multiple RRSPs with different institutions. And I found that the quickest and simplest way to open an RRSP or other registered plans is through online investment apps like Wealthsimple or Questrade. Wealthsimple is especially fast when it comes to account opening and moving money around. After opening an account with them, it only takes minutes to open an RRSP. It has an edge for beginners as I find it more user-friendly and easy to use. There's also no fee for both buying and selling stocks and ETFs. So in case you want to open an account with them, I left my referral code and link in the descriptions below. And once your account is funded, both you and I will get a bonus of $25. Now on to the numbers example. How much taxes can you actually save by contributing to an RRSP? Last year, both I and my husband combined got a tax refund of $8,000 from the CRA, which was mainly the result of contributing money to our RRSP, thereby reducing our taxable income. The amount will of course be different for everyone. There are mainly two factors that affect how much taxes you can save or defer, to be precise. One is your deduction amounts, and two, income, which determines your tax bracket. Let's look at following number example. Say you earn $70,000 from employment and have $0 in RRSP deductions. That means your taxable income is still $70,000. And here I want to differentiate between contributions and deductions. When you contribute to your RRSP, that means you put money into it. You can choose to deduct the amount or not. If you deduct it, and you can do this during tax filing, the amount will reduce your taxable income. If you choose not to deduct it, then for now the money will just sit in your RRSP, but you can deduct the amounts in future years. I will explain more about this later. Now let's look at how much taxes you would pay approximately. Your income taxes consist of federal and provincial taxes, which differ by province. Both federal and provincial taxes are progressive, meaning they are broken up into tax brackets, and a higher tax rate applies to a higher income bracket. Note that these are 2024 tax rates, and both brackets and rates may change. If you earn $70,000, for example, the first $55,867 will be taxed at 15%. That equals $8,380. Then the difference between $70,000 and $55,867, which is $14,133, will be taxed at 20.5%, which equals $2,897. So your total federal taxes are $11,277, approximately. Note that this is only an estimation, as this calculation does not include CPP-EI, other deductions, and the basic personal amount. The BPI is an amount of income that is not taxed, by the way. Also, disclaimer that I am not a financial advisor or tax consultant, and I'm just sharing what I have learned over the years on my own financial journey. Then we do the same calculation for provincial taxes and arrive at $4,296 in taxes. Your total taxes would now be $15,573. This equals an average tax rate of 22.25% in this example. But you can reduce this amount if you contribute to your RRSP and also deduct the amounts. So here we have the same earned income of $70,000, but this time we have $15,000 in RRSP deductions. This means that instead of $70,000 getting taxed, now you're only getting taxed on $55,000. Now let's apply the same calculation of federal tax, $8,380, and provincial taxes, $2,923. And we arrive at a total tax bill of approximately $11,303. That's an average tax rate of 16.15% instead of 22.25%, and a total tax savings of $4,240. As in most cases, you would have already paid your full taxes on the $70,000. Usually your employer would deduct those taxes. However, as you've contributed $15,000 to your RRSP and deducted the full amount, you only have to pay taxes on $55,000. So it's highly likely that you will be receiving a tax refund of approximately this amount. And that's awesome, because now you can go and invest it again in your RRSP if you want, or TFSA, or elsewhere. But now when and how do you get this tax refund? Normally, you would file your taxes sometime between January and March, so around this time, to meet the tax filing deadline of April 30th. When you file your taxes, you will need to report your RRSP contributions. You can easily get this number from the financial institution that you have your RRSPs with. Usually at the beginning of the year, they will send you a report of all your RRSP contributions. But I'd highly recommend that you also keep track of your contributions yourself so you can compare if they're accurate. During tax filing, there will also be a line where you can claim your RRSP deductions. For example, you've contributed $10,000 this year, but you only want to claim $5,000 in deductions. Why would you possibly want to do that? I'll explain later. Important note about the timeline. The deadline to make contributions to your RRSP is March 3rd for this year. It's always 60 days after the end of the year, so you still have some time to make any additional contributions until then. Anything contributed after March 3rd will go into next year's tax filing. After you file your taxes, you'll usually get an NOA, a Notice of Assessment from the CRA, which tells you whether you owe them taxes or if you are eligible for a refund. If you filed online, it usually only takes about a month or so, and you'll get your refund shortly in your account. But there's actually a way that you can get your refund earlier using what's called the T1213 form. You basically list deductions that you plan to make when you file your tax return, including your RRSP contributions. So instead of waiting for the whole year to get your tax refund, you can now get it throughout the entire year. Now this sounds all great, and you're probably eager to start contributing as much as you can. But note that there are limits as to how much you can contribute. Here's how the CRA calculates how much you can contribute, or your contribution room. It's the lesser of these two items, 18% of your earned income in the previous year and the annual RRSP limit. For the year 2024, that was $31,560, but it changes each year, and you can check these numbers on the CRA website. In our previous example of $70,000 income, your RRSP contribution room for this year would be 18% times $70,000 equals $12,600, since $12,600 is less than $31,560. To that contribution room of $12,600, you'll add any unused contribution room that you've accumulated from previous years. Because each year you earn income, you are entitled to get additional contribution room. But if you didn't contribute anything, you can carry forward that amount to the next year. Let's say that's $30,000 in unused contributions. So you add that to $12,600 and we arrive at our total deduction limit. Now, it's a good idea to track all your RRSP contributions, but to know for sure what your contribution room and deduction limits are, you can find that out by going to your CRA account. You can simply log in using your bank's sign-on credentials. In the past, at least, the numbers were also listed in your NOA or Notice of Assessment. One important note here, if you have a group RRSP with your employer, your contributions to this will also count towards your overall RRSP contribution room. So make sure that you factor that in. In general, make sure that you don't exceed the allowed contributions because there will be a penalty. If you over-contribute to your RRSP, you'll generally have to pay a tax of 1% per month. So for 12 months, that would be 12%, a lot. There's a buffer of $2,000, meaning that the penalty will only kick in once you've over-contributed by more than $2,000. But I wouldn't go there. There's no use because despite over-contributing the $2,000, you can't deduct it and it won't reduce your taxable income. One question people often ask is also, what if my contribution room is, let's say, $20,000 and I've contributed $20,000 and invested it, but then it grows to $25,000? Doesn't that mean that I've exceeded my contribution room? The answer is no, because what counts is only the deposits that you make. It doesn't matter by how much your money grows. Talking about growing your money, what do you actually do once you've contributed your money into your RRSP? Don't let it lying around there for sure. While you still benefit from RRSP deductions by paying less taxes, the added benefit actually comes from investing your money. Within your RRSP, you're allowed to invest in most investment products, including GICs, stocks, bonds, ETFs, and mutual funds, but not crypto. The most you can do are crypto ETFs. In the past, I've mainly held stocks and ETF index funds in my RRSP. One unique aspect of the RRSP is that RRSPs are exempt from US withholding taxes on dividends. And this is what it means. When you buy US stocks or ETFs that pay dividends, the US usually imposes a withholding tax on the dividends so that you receive less. But when you buy those US stocks or ETFs in an RRSP, there is no withholding tax and you get your dividends in full. That's something to consider when you choose how you want to utilize your RRSP. Personally, I am holding US stocks in my RRSP. So far so good, but what about withdrawing money from your RRSP? Here's the thing, you can withdraw money from your RRSP anytime you want, but there is a tax consequence. Once you withdraw money from your RRSP, it becomes taxable income. If you've invested the money, first of course, you will need to sell your investment and then withdraw the money. What happens immediately upon withdrawal is that the financial institution you have your RRSP with will charge a withholding tax. This ranges from 10 to 30% depending on how much you withdraw. If you withdraw $20,000, for example, the financial institution will charge you 30% or $6,000 in withholding taxes. This is temporary. Once you file your taxes the following year, your withdrawals will be counted together with all your other income to determine if you have to pay more or less in taxes. One important thing to keep in mind is that once you withdraw money from your RRSP, your contribution room is gone. Unlike with a TFSA, where you can withdraw from it 1 year and it gets replenished the next year, for the RRSP, once taken, it's gone, so consider it wisely. There are exceptions though. If you withdraw money from your RRSP to use for the HBP or home buyer's plan, the limit is $60,000 by the way, or for the lifelong learning plan of up to $10,000, you will not be charged a withholding tax. It doesn't mean, however, that you'll not eventually pay taxes on this money. Another way to withdraw money from an RRSP is via a RRIF or Registered Retirement Income Fund. You can do this anytime, but latest when you are 71 years old, your RRSP will be converted into a RRIF. Once your RRIF is set up, you have to start withdrawing money from it based on a certain percentage, which is determined by the government. Note that the money withdrawn is taxable income, so you have to pay taxes on it when you file your taxes. But as long as you don't withdraw more than the minimum amount, you at least won't be charged those withholding taxes. The last way to withdraw money from an RRSP is via spousal income splitting so that you'll pay less in taxes. Now to a very important question that's hotly debated. Should you contribute to your RRSP now or better later? The argument usually goes like this. If you're now in a relatively higher tax bracket, let's say you earn $120,000, you pay a high marginal tax rate. For federal, that's 26%. And through RRSP deductions, you can defer a lot of taxes. Later, when you retire and say your income is much lower at only $50,000, you're in a lower tax bracket, 15% for federal. This means that you can save a lot of taxes by investing in your RRSP now. Conversely, if you're now in a lower tax bracket, let's say $50,000, you won't save that much on taxes now, only about 15% in federal taxes. If instead you wait until your income goes up to $120,000, let's say in a few years, you will be able to save much more in taxes. So whether or not it's a good idea to contribute now or later really depends on your personal situation, your earnings, but also your assumptions about how much you'll earn in the future. And that's hard to predict because life often turns out different than we plan. And here's another argument, my personal opinion about this that I rarely hear mentioned online. Apart from the possible benefit of saving more taxes by waiting to contribute and claim deductions later, let's say you expect to move up 2 tax brackets in 5 years from now, that's when the higher taxes will really make a dent, there's also an opportunity cost. Yes, you might save 10% more in taxes by waiting 3 to 5 years until your income is higher, but on the other hand, you'll lose out on the opportunity of investing the tax savings now. Say you earn $50,000 now and somehow you manage to invest $10,000 in your RRSP, giving you an approximate savings of $1,500, 15% federal taxes of $10,000, not counting the provincial taxes. Although the tax savings isn't as much, you can immediately invest that $1,500 and your money can compound over those few years. So it's up to you to decide if the benefit from contributing while in a higher tax bracket outweighs the benefit of having the money now to invest. It will largely depend on how much you can yield on that investment. If its projected growth is over 20%, then it's worth considering, not if you put it in a checking account. So when making this decision, always ask yourself, what is my opportunity cost? What are my other options? If you have other options to put that money to good use, you might have a case for contributing and claiming RRSP deductions earlier, although you're not earning as much. Personally, I like to take a mixed approach. I mainly invest in my TFSA because I believe that my income will still grow by a lot in the next years, but I also invest a bit in my RRSP to reduce my immediate tax bill so I can reinvest a bit of that money. Side note, I also invest in non-registered accounts because I buy Bitcoin. Let me know what you think in the comments below. Also, in case you don't have an RRSP yet and want to quickly open one without any hassle, consider Wealthsimple. Link and referral code are down below. To get started, you can also watch my Wealthsimple tutorial right here.